Neil Herman, welcome. So I think it's fair to say the portfolio has a bit of a mid-cap bias. What would you say is contributing more strongly to returns? Is it earnings or M&A?
M&A has been useful. We've had a number of bids in the portfolio over the last 12 months. More recently, for example, we had a bid for Domino Printing from Brother International, CSR from Qualcomm, and Synergy Healthcare was bid by Visteris. So they've been helpful to performance, but the key driver of performance in the trust over the last few years has been earnings growth. It's been certainly superior to the market, which is very, very positive, but also the reliability of earnings growth in the portfolio has been much better than the market, which has seen downgrades.
Neil, we've got an election tomorrow. Do you see anything in the outcomes that could affect the companies in the portfolio?
We tend to shy away from companies directly in the firing line of the election, so we've not got any kind of bus and rail stocks, any of the bookies or any utilities in the portfolio. I think the risk will be about market risk. Clearly, obviously, very uncertain outcome tomorrow, clearly I think the market would obviously prefer a certain conclusion rather than the uncertainty of a potential coalition government. So I think it's more about market risk in the portfolio rather than specific company risk.
Portfolio prices with a bit of a stubborn discount, but you've had good performance. Is there anything that's going to bring this in?
It's a little bit frustrating. It's a good question, really. Why do we trade such a big discount? I think you can say that we've had some success recently. We're very much an outlier in terms of high discount than the rest of our investment trust peers. That's reversed. We're now in the middle of the pack, which is positive. Discounts have moved out more recently, though, I think due to uncertainty of the election and by a strike, essentially. So I think we can see the discount come in, hopefully, post-election and some conclusion from that.
Portfolio has quite a bit of fixed gearing. Would you have it as high if you had the choice?
An element of our gearing comes from the debenture, which is a fixed, as you said, fixed gearing. That does expire in May 16, so not too far to go, only a year to go on that. I'm reasonably comfortable level of overall gearing. It's about 10% as it currently stands. I think considering the positive outlook on the medium term for the markets we have, that's a fair level of gearing to have.
Okay, finally, Neil, valuations. The market's been performing well and valuations in mid-caps have run. So it seems as if the smaller caps, the AIM stocks, are a little bit cheaper. Is that where you're looking?
There's a number of reasons why we're not quite as high as AIM as you might suggest. We do invest in AIM stocks, about 9% of the portfolio is in AIM, so we don't ignore that area of the market. You've got to remember also the trust is a reasonable size, 600 million gross assets. For us to get involved in a stock, we need to put a reasonable amount of money to work in it, and AIM stocks generally are too small for us to look at. Additionally, AIM is very heavily resource-based, oil and gas and mining. Again, areas we don't normally look at as our investment process. Also, I think this value in the AIM is slightly illusory. I think if you look at it, the quality of the analysts or analyst coverage in AIM is quite low. Forecasts tend to be somewhat less reliable than the other listed companies. And we tend to find the AIM companies aren't quite as cheap as you think they are when you come to reality.
Neil Herman, thank you.
Thank you.